In today's video, I'm going to be sharing with you a complete guide to Bollinger Band trading strategy. In this video, you are going to learn a lot about the Bollinger Band indicator. You are going to perfect it very well, and you'll be able to use this trading indicator to make money consistently in the forex market. So my advice to you guys is to make sure that you watch this video from the beginning to the end, so that you will understand what this video is talking about. In today's video, we are going to be looking at the Bollinger Band. The Bollinger Band is an oscillating indicator which was developed by John Bollinger in the 1980s. The Bollinger Band indicator is used to identify the tops and bottoms of a price range. It helps to know the overbought and the oversold condition of a market, right? So Bollinger Band works in different market conditions, so you should know when to implement it during a trending market and when to implement it during a ranging market. And please do not use Bollinger Band indicator alone. You need to include it with price action like support and resistance level, right? So when you identify the upper Bollinger Band, you can be able to look for a resistance level for you to be able to confirm your entry. And when you identify a lower Bollinger Band, a lower band, you need to look at a support level for you to be able to have a better entry. So you need to at least combine price action, support and resistance with the Bollinger Band indicator for you to be able to trade this strategy profitably. So what you're going to learn in this video, you're going to learn what a Bollinger Band is and how it works, right? That is what you're going to learn. You're also going to know the biggest mistakes that some traders make while using the Bollinger Band, and I'm going to try my best to correct that mistakes in this video. You're also going to learn practical trading techniques, like how you can be able to identify explosive breakout using the Bollinger Bands. So with the help of the Bollinger Band, you'll be able to know when a breakout, an explosive breakout, is about to occur. So you are going to learn it in this video. And also you can be able to use the Bollinger Band to do what? To better time your entry. You can be able to time your entry using the Bollinger Band. And lastly, you are going to learn how you can use the Bollinger Band to ride massive trend in the market. So now let me share my screen with you guys so that you understand what I'm talking about. Now if you look on the screen now, this is how the Bollinger Band looks like. So if you want to plot out the Bollinger Band, you can simply go to your trading view and click on indicator, right? So once it pops out, simply type Bollinger Band and it will come out. Then you click on it, it will appear like this, right? So this is how a Bollinger Band looks like. It has three components: the upper band, the lower band, and the middle band. So the middle band is the 20 EMA, right? Is the 20 exponential moving average. That is the middle band. While the upper band is used to do what? Identify resistance level. While the lower band is used to identify support level. So these are the three components of what? Of a Bollinger Band indicator. Now, when you look at the upper band tells us that the market is too expensive. That is, the market is in overbought condition, right? So when the price crosses above the upper band, it tends to return back into the Bollinger Band, because when price crosses above the upper band, it tells you that the market is too expensive. The same thing applicable to the lower band. When price crosses below the lower band, it tells you that the market is too cheap or the market is in an oversold condition, right? So that is why whenever the market comes out from the lower Bollinger Band, it tends to return back, right? Because when the price is at the outer lower band, it tells you that the market is in a cheap price, so buyers can step in and push the price up. And when the price is at the outer upper band, it means that the market or the price is too expensive, and the sellers will step in and then sell the market. So this top is what we call the upper Bollinger Band, while this one is what we call the lower Bollinger Band. So whenever price is above this upper band, it means that the price is too expensive, and whenever price is below this lower band, it means that the price is too cheap. Then this middle line is the moving average, right? So it is the moving average that demarcates between the upper band and the lower band. Now I want to correct some mistakes that some traders normally make whenever they are trading using the Bollinger Band. The problem or the mistakes that some traders make is that whenever they are trading the Bollinger Band, they forget to trade it along with market structure. And like I told you, if you want to be a successful forex trader, you need to understand market structure, right? So once you understand market structure, you will know when to use a Bollinger Band and how to use it in different market conditions. Now if you look at this chart very well, you can clearly see that the market is in an uptrend, right? But the fact that the market is making higher high and higher low, higher high and higher low, higher high and higher low, it tells you that the market is clearly in an uptrend. And when the market is in an uptrend, the market tends to be crossing the upper Bollinger Band consistently, right? So the mistake that some forex traders do is that when the market crosses above the upper band, they tend to sell, and when they sell, the market will just make a little pullback and the uptrend continues, right? So that is why I said Bollinger Band can be used in different market conditions, right? You need to change strategies in different market conditions. If the market is clearly in a range like this is clearly a ranging market. If you look at this, you know that this is clearly a ranging market, right? So whenever the price comes to the outer Bollinger Band, you simply sell, right? And whenever the price comes below the Bollinger Band, you simply buy. You can clearly see that the price breaks above the upper Bollinger Band, the sellers came in and push it down. And what happened here? The price break below the lower Bollinger Band, the buyers came and push it up. And then price breaks above the upper Bollinger Band, the sellers came and push it down. So for you to trade based on the tops and the bottoms of the Bollinger Band is when the market is ranging, when there is a consolidation in the market, when both the buyers and the sellers are exchanging price. So that is when you can trade the upper and the lower Bollinger Band, not when the market is trending. So that is what I want you to understand. So if you watch clearly on this chart, you can clearly see that the market is ranging, right? That is why the sellers sell from the resistance level while the buyers buy from the support level. So once you see a ranging market like this, you simply use your horizontal line to map the resistance level and the support level, right? So that when the price comes out of the upper Bollinger Band, you look at the resistance level to know whether if the price is close to the resistance level for you to sell. And when price crosses below the lower Bollinger Band, you also look for support level to know whether if support level is close to the price for you to take a buy trade. So you need to at least add price action like support and resistance level to this ranging whenever you are trading the Bollinger Band, so that it will give you a better entry, to give you the best entry that you need. Now when you look at this chart, you can clearly see that the market is going up. So some traders will make the mistake of selling whenever price comes to the upper Bollinger Band, and once they sell, what happens is that the price makes a pullback a little to the 20 EMA and then continue going up, right? And unluckily for them, they will not be able to get anything, because as they place a buy trade, the price will just make a pullback, right, and then continue going up and hit their stop loss. So what you do in this scenario is, once a price is in an uptrend, you don't need to sell when the price gets to the upper Bollinger Band. So what you need to do is to trade in the direction of the trend. right? So in this scenario, you should be looking at the 20 EMA, which is this middle Bollinger Band, right? Or you should be looking at the lower Bollinger Band, because the market is currently going up. So you should just remove your mind from the upper Bollinger Band. Whenever the price makes a move to the upper Bollinger Band, don't trade. Just wait for price to make a pullback to either the middle Bollinger Band, that is the 20 EMA, or price makes a pullback to the lower Bollinger Band for you to buy, because during an uptrend you are only meant to buy. The same thing applicable during a downtrend. So during a downtrend you are only meant to sell, while in an uptrend you are only meant to buy. So this is the mistakes that so many forex traders are making. So I'm advising you this time around to try and change and don't trade this way, because if you are selling when the price is trending up, you are making a big mistake, right? Because if you watch, you see that the price went up, makes a little pullback, went up again, makes a little pullback, went up again, makes a little pullback, went up again. So if you watch, you see that only buyers will make money in this setup, because the market is clearly going up. So in this scenario, you should not bother selling when the price gets to the upper band. You should only wait for price to make a pullback to this middle band, or for the price to make a pullback to this outer lower band. That is where you're expected to place your buy trade. Right now, another thing that I want to make you understand about the Bollinger Band. The Bollinger Band can help you to identify when an explosive breakout is about to happen, right? And you know that before a breakout happens, there is always a tight consolidation, right? There is always a tight consolidation before a breakout happens. So with Bollinger Band, you can be able to know when a huge breakout is about to happen, when an explosive breakout is about to happen. And what happens is when the price enters into a tight consolidation. In other words, we call it the Bollinger Band squeeze, right? If you look at this chart very well, you can see how small the candlesticks are, right? This is what we call the Bollinger Band squeeze, right? You can see that before the market was in a high volatility, right? And then suddenly the market began to compress, right? And became this tiny. So this is what we call the Bollinger Band squeeze. So once you see that the Bollinger Band has squeezed and the price is very small, ranging within the upper and the lower band, in this scenario you cannot trade the upper and lower band, because the market is in a tight consolidation. You can only wait for breakout, right? Because if you watch from the top to the bottom, there's no space, right? So this is what we call the Bollinger Band squeeze. So this is what the Bollinger Band will help you to know when a big or explosive breakout is about to happen. We call it the Bollinger Band squeeze. So once you identify this type of price action on a chart, you should only wait for a breakout. You shouldn't buy or sell. You should just calm down and wait for a breakout, because at this point the market is in a tight consolidation, right? So it depends on how long this consolidation happens. If this tight consolidation takes long while forming, it means the breakout is going to be explosive, right? So if you watch that the range took long before it completed, right? So after that, what happened? A breakout happened, right? So you can see the massive explosive breakout. So if you were able to catch this type of breakout, imagine how many pips you'll be able to catch, right? So this is what we call the Bollinger Band squeeze. This is a period of low volatility. At this period, there were low volatility. There is no selling or buying pressure, because the candlesticks are very small and the Bollinger Band has compressed. The Bollinger Band has squeezed. So in this scenario, you don't have to do anything. You just exercise patience and wait for breakout, right? And then after a long period of low volatility, a long period of Bollinger Band squeeze, what happened? The market finally broke below the lower Bollinger Band, right? And then what happened? The downtrend begins. So if you are watching this type of chart, you should use a horizontal line to map the lows and the highs for you to know when the breakout actually occurred. So if you watch, you see that from this candle you can mark the lows, while from this candle you can mark the highs, right? So you're now waiting for a breakout. So once the price breaks below the support level or below the lower Bollinger Band, you simply place a sell trade and your stop loss will be above the upper Bollinger Band. Right now, what will be your take profit? Your take profit is when price breaks above the 20 EMA, which is the middle Bollinger Band. When price breaks above it and continue heading up, that is when you are expected to take a profit because the trend have changed, right? So you have to hold on to your trade until the price breaks above this 20 EMA, this middle Bollinger Band, for you to take your profit. Because if you watch, you see that breakout always tends to be a change of trend. So once the price breaks above the 20 EMA, it means that the trend have changed from a downtrend to an uptrend. So if you watch, you see that after the tight consolidation, the price finally broke below the lower Bollinger Band and the downtrend begins, and you can see the drop right until the price got to this low and then makes a pullback. Unfortunately, the price made a pullback to this point and came down, then went up and break above the 20 EMA. So once the price breaks above the 20 EMA, you don't need a prophet to tell you that this is the right time to close your trade, right? For you to secure your profit, right? So for me, I would say that at the close of this green candle, you are expected to close your profit, because if you still leave your profit, you'll be surprised that the price will come back and maybe hit your break even and you lose all this profit. So it is always advisable that you once in a while you monitor your chart to know whether if there is a break of market structure. So that is it for the Bollinger Band squeeze. So now, if the market is trending down, like I said, if the market is trending down, the price will be hugging the lower band of the Bollinger Band, right? If the market is going down, the price will be hugging the lower band. But if the market is going up, the price will be hugging the upper band. So when the market is trending down, you don't need to buy at the lower band, and when the market is trending up, you don't need to sell at the upper band, right? Because if you do that, you are going to get hot. Where are you expected to sell? You are expected to sell when the price makes a pullback to the 20 EMA. That is where you are expected to sell. So if you watch this chart clearly, you see that the market is clearly in a downtrend, making lower high and lower low, lower high and lower low, lower high and lower low. So in this scenario, you are not expected to buy when the price breaks below the lower band, right? Once price breaks below the lower band, you are not expected to buy. What you have to do is to exercise patience and wait for price to make a pullback to the 20 EMA, which is the middle Bollinger Band. So once price makes a pullback to the 20 EMA and get rejected, then you can simply place your sell trade, right? And then trade in the direction of the trend, because the concept of this is for you to always trade in the direction of the trend. Like I always said, do not trade against the trend. If the trend is up, trade in the direction of the trend. You have to buy only. But if the trend is down, trade in the direction of the trend. You have to sell only. So like I said, if the price is trending down, the price will tend to be crossing below the lower Bollinger Band, because if you watch, you see that the price is always crossing below the lower Bollinger Band. You can see it clearly. The price is always crossing below the lower Bollinger Band. So if you tend to buy, right, you will not be able to gain anything, because the price will just make a little pullback to the 20 EMA and the downtrend continues. So that is why this 20 EMA is there for you. So whenever price is trending down, you should be looking at this 20 EMA for a pullback, and whenever price makes a pullback to the 20 EMA, you simply sell. Like now, if you watch here, you see that the price rallied down, right? The price breaks below the 20 EMA, rallied down, breaks below the lower Bollinger Band, and then makes a pullback, right? So if you decide to buy here because the price breaks below the lower Bollinger Band. If you decide to buy here, the price will just make a little retracement to the 20 EMA and then continue heading down. So let's assume maybe your take profit is like 50 pips and 50 pips is somewhere here, right? Then your stop loss will be like, let's say 50 pips, and your 50 pips will be here. What happened? The price will just make a pullback to the 20 EMA, and this is your take profit, right? You can see that the price is still far away from the take profit. And what happened? The price now got rejected from the 20 EMA and then rallied down. What happened? The price will now hit your stop loss and you are going to lose. So that is why I said, if the market is in a down move, you have to trade in the direction of the trend. So in that scenario, once the price makes a pullback, in that scenario, when the price breaks below the moving average and then crosses below the lower Bollinger Band, you don't have to buy. You simply exercise patience and wait for price to make a pullback. And when price makes a pullback to 20 EMA, this is when you are expected to sell. So you simply place your sell trade at the close of this red candle, and your stop loss will be above the upper Bollinger Band, right? So you place your sell trade here and your stop loss will be above the upper Bollinger Band. So where will be your take profit? Like I said before, you have to trail your stop, right? You have to trail it and then wait for a crossover. Now if you're able to trail your stop, you are going to be able to cash all these pips, right? Because price has not break above this 20 EMA, telling you that the down move is still in progress. So you are waiting for a crossover. You are waiting for price to cross above the 20 EMA for you to confirm a change of market structure, right? So when price now cross above the 20 EMA, it tells you that the trend have changed from a downtrend to an uptrend. So but if the price is still holding at the 20 EMA, it means the downtrend is still in progress. So at this period, once your sell trade is here and your stop loss is here, you will be able to cash all this move. So you'll be watching the price, watching your chart, and be waiting for crossover. So this is where the crossover finally happened. So once you confirm that the crossover has happened, at the close of this green candlestick, you are expected to close your trade. Because if you continue holding onto your trade, you might end up losing your profit. So in this scenario, you are expected to close your trade at the close of this green. Once the price crosses above the 20 EMA, you simply close your trade at the close of this green, right? Because if you hold on to your trade and a crossover occur and you don't do anything, to your greatest surprise, the price will rally up and maybe hit your break even, and you're not going to make any profit. So that is why you need to always pay attention to the market. You need to always monitor the chart to know what the market is doing. Not when you place a trade, you just forget about it. Once in a while, you need to go check your chart to know what is happening, right? So if you are a type of trader that doesn't monitor your chart, you may not know when the crossover will occur. Maybe you have gotten so many pips starting from here. You have gotten so many pips, you have secured so many profits. For the fact that you are not there to monitor your chart and the price broke above the 20 EMA, to your greatest surprise, the price will rally up, and if care is not taken, the price might even hit a stop loss. So that is why it is advisable that you always monitor your chart. So this one is for the uptrend, right? The same thing applicable for the uptrend. If the market is in an uptrend, the market tends to cross above the upper Bollinger Band. So in this scenario, you are not expected to do what? To sell at the upper Bollinger Band. You are only expected to buy. And where do you buy? You wait for a price to make a pullback to the 20 EMA for you to buy. So if you watch that, this is clearly a resistance level, right? So this is the period of consolidation where buyers and sellers are in equilibrium, right? So in this scenario, you can simply trade the upper and lower Bollinger Band perfectly, right? You can simply trade it because you can clearly see that the market is in a range. So in this scenario, when the price comes to the upper Bollinger Band, you simply sell, and when price comes to the lower Bollinger Band, you simply buy, right? Because the market is clearly in a range. So but if the price eventually breaks above this resistance level and an uptrend begins, you need to change your strategy, right? You don't need to buy at the upper Bollinger Band again because the market has entered into an uptrend. So what you have to do is to wait for price to make a pullback to the 20 EMA for you to buy. So if you watch, you see that as price breaks above the resistance level, the price rallied up, right, got to the upper Bollinger Band and then crossed above it. So if you are to sell, right, this is where the price tends to gain support. So it is better and advisable that you only buy. So once the price breaks above the resistance level and then goes to the upper Bollinger Band, you exercise patience and wait for the price to make a pullback or a retracement to the 20 EMA for you to place your buy trade. So you can clearly see that after the price breaks above the resistance level, the price rallied up to this outer Bollinger Band, to this upper Bollinger Band, and what happened? The price now made a pullback to the 20 EMA and the uptrend continue. So once the price gets to this upper Bollinger Band, don't sell, exercise patience and wait. So when the price makes a pullback to the 20 EMA, this is the right time for you to buy. So you simply wait for this green candlestick to close, you place your buy trade, and your stop loss will be below the outer lower Bollinger Band. And like I said before, you can trail your stop loss, right, and wait for a crossover for you to be able to close your trade. So for the fact that the price is gaining support from the 20 EMA, it means that the uptrend is still in progress. So you simply wait for a crossover, right, for you to close your trade. So when the price eventually crosses below the middle Bollinger Band, which is the 20 EMA, you simply close your trade. So you can clearly see this is where the crossover occurred, and this is the candlestick that caused the crossover. So what you have to do is you wait for this candlestick to close, and once it closes and you confirm that the crossover has happened, you simply close your trade. Otherwise, the price will reverse against you and maybe hit your break even or your stop loss. So for you to trade Bollinger Band, you need to be extremely careful, right? You need to be extremely careful. Remember that you don't trade it the way you trade it during a ranging market. During a ranging market, you can buy the tops and the low, right? During a ranging market, you can sell at the Bollinger Band upper band, and you can buy at the Bollinger Band lower band if the market is in a range. But if the market is trending up, you only buy when the price makes a pullback to the 20 EMA. So ladies and gentlemen, that is all I have for you in today's video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be the first to be notified whenever I publish new content. I will see you again in my next update. Bye.